Again, as I kind of said in my spiel, I don't need to repeat it too much, but this is a sector that is really expanding into retail. And there are a lot of questions as to what this product is and what it means for our time. But I think it's helpful, Brad, if I can just start with you, of taking a step back, because this is a project that Blackstone has been working on for a while. Why is this a market that is even suited for retail? Why push into this audience?
Yeah, well, thanks for having me. This isn't new, so maybe taking a step back, I think I like how you frame that. Blackstone's been distributing product to retail for over 20 years. In fact, we started 40 years going into institutions who wanted to diversify their portfolio mix away from being 100% allocated to liquid assets. Why? Because they didn't need 100% liquidity. They could get a return premium by being in alternative illiquid assets. So we started on this same journey with retail individuals through the wirehouses 20 years ago, with the same goal of delivering them a product which they could allocate to a portion of their overall portfolio. About 10 years ago, we realized there was additional product innovation structures that would make it easier to distribute these products to individuals. We had a non-traded real estate product we started, and then we had a non-traded BDC product, which is being active in those channels. And it's delivering exactly kind of what we thought it would, which is a return premium to what they can get in the public markets. And they can build portfolios similar to how our institutions are building their portfolio. So that's the why, and that's kind of how we've gone about it.
Vivek, of course, Goldman Sachs comes from sort of a rich history of putting portfolios together for high net worth and wealth clients. How does the project look at Goldman Sachs of expanding into retail?
Yeah, so we've approached retail very slowly and methodically. We think that, I agree with what Brad said, which is we think there is a role when done the right way, and we should double click on what that means. But when done the right way, we do think there's a role that private assets can play in the right retail portfolios. But the two things that we think are really important when you double click on do the right way is one, understanding that and making sure that the retail customer understands that this is an illiquid asset class. Part of the reason that you get a premium in private assets versus public assets is for the illiquidity. And so we think that's important to understand. Now, some of these newer structures do offer some interim liquidity on a best efforts basis relative to a drawdown fund. We think it's important investors understand that those vehicles often come with parameters around gating and so on if there's too many people redeeming at the same time. And we think it's important to understand that those features are actually features and not bugs. Because what that gating allows is it allows the GP to actually protect the investor and the fund from the type of value degradation that can happen in the context of sort of fire sales. And so when investors understand that and go into eyes wide open, we think that the opportunity for them to get access to on day one sort of immediately deployed, immediately diversified portfolio where you're earning a kind of a risk premium for private versus public, we think that makes a lot of sense, but we just think that it needs to be sort of done in the right way.
Yeah, and how do you
maybe just
go
to
ahead, please.
Add on to that, because I think it's important for people to appreciate in the institutional world, 30% of their assets are in these non-traded, illiquid alternative products. In the individual world, it's 1%. So we are kind of early in this progression of delivering alternative products to help them build out their portfolios.
Well, Anne, how do you see this? Because, again, I'm sure you would agree that this makes sense for a retail audience. But how do you make sure that they understand that it's illiquid, or do you need to make sure you have a portfolio that's semi-illiquid or can access more liquidity by investors when they're in these?
Yeah, and it's a really interesting question because all of us have obviously lived in the illiquid alternatives world for a very long period of time. And you learn over many years when you're managing a portfolio that you can put a certain amount into these illiquid investments, right? And because everyone has a lot of other investments, you don't need to have full liquidity all the time, right? And so as you grow up, and I've lived in this, from doing my first illiquid investment in my 20s, you start to educate yourself. And I think that that's what is happening at the moment. There's a huge amount of education Blackstone's been doing it for a long time. The world is now learning how to put these illiquids into their portfolios, right? And I think it is education that's missing, right? So I always get struck by the number of companies which are not listed anymore, right? I think 30 years ago it was 8,000 companies. Now we're down to half that. So you're just missing out, right? It's like I get frustrated when I can't get into these tech companies, before they go. I mean, people have just been missing out on these opportunities for a really long period of time. So it's up to all of us as professionals to really educate folks as to this illiquidity premium and how to put that in a portfolio. Because I think fundamentally these assets are illiquid, and you're putting a structure, a wrapper that is trying to make them liquid on top. And that's where the friction emanates from. So the more education we can give folks, I think the better we're going to be off, in terms of being able to get more people into these type of assets.
Brad, if I may, you might be living through a case study of the liquidity profile right now. I looked at my Bloomberg terminal this morning at the red go function, seeing the most red stories, and it went markets wrap, Blackstone record redemptions for BCRED, and then war in Iran. Just to let you know where you're sitting in the pecking order. I would love to just take a moment in the opportunity just to explain what's happening at BCRED, what the redemptions look like, and how you're meeting those.
Yeah, I used to not get invited to cocktail parties. Now I get the invitation, so private credit is sexy again, which is great. This isn't the first time we've lived through this. We have a non-traded BDC that had elevated redemptions for a period of time. In fact, I think that product has been in existence for 9 years. I think 8 of those years it had normal redemptions, and then for a short period it had elevated redemptions, and all investors got out within kind of 4 months. So it's actually a very good case study of what we're going through generally in the non-traded private credit space. And that product, interestingly enough, delivered a 65% return premium over that 9-year period. So I'm just giving that as a framework because as you think about what investors are signing up for, illiquid products or semi-liquid products for a return premium, and we saw that play out. But yes, you're right. We did announce last night we had elevated redemptions. If we start with kind of just underlying performance, and I think Vivek will say the same with their products, we're actually seeing very good credit fundamentals. The fund has delivered a 10% return since inception, 50% premium to the liquid market. So it's doing what it's supposed to do. But there's a lot of noise in the market, which we should spend time on. And that has resulted in elevated redemptions. And we decided that we should meet those 100%. It was a little bit higher than it was in the previous quarter, but we felt it was important to honor those redemptions for our investors. And importantly, we also saw a lot of inflows during the quarter. So it's a little bit of, you have a portion of the market that is reading the headlines and wants to redeem, and then you have another portion of our investors who are actually signing up, subscribing, because they believe in the return premium you can get in private credit right now. And that number was around $2 billion for the quarter, a very healthy number, including our own capital.
Can you continue to meet redemptions if they exceed 5% in quarters to come?
I think every quarter we look at it and assess the facts on the ground. This is the third time redemptions have been above 5%. So when rates spiked in 2022, we had a similar backdrop, and we met those redemptions. So every time we've met them, and we'll assess the facts on the ground next quarter.
And just to bring it to you, I mean, this is by no means a Blackstone-specific issue. As Brad, as you hinted at, there's a lot of concern, a lot of noise, a lot of headlines. The statistics for January, for example, saw that net inflows into non-traded BDCs were 40% below where they were in December. Is there a real moment right now of questioning the asset class from retail investors, and is any of it valid?
So, I mean, the headlines are scary, right? There's a lot of headlines out there from the frauds which happened, and then to obviously Blue Owl and what was happening with their BDC. And so I think if you don't know what's happening underneath the hood, if you don't live in the industry and understand what's happening, it can be scary, right? If you're a mom or a dad, or and so I do think that that's where it comes back to education. From our perspective, the growth in private credit is going to continue, right? Obviously, it's had a huge amount of growth over the last decade. It's going to be projected to continue for the debanking. Every deal that's being done out there needs to have credit, and so we believe in the continued growth. So I think you've got to think about the fundamentals. These are effectively just loans being made to companies, right? Either sponsor-backed companies or non-sponsor-backed companies. And so you've got to think about each individual loan. Just because of a couple of frauds or some headlines around a BDC that was structured using old technology, that doesn't mean that every single loan out there is bad, right? And so I do think that institutions are much more knowledgeable, in general, versus retail investors. Mm-hmm. We're also seeing institutions ask questions about these headlines, right? So, but my view is this is actually all very healthy, right? This is all very healthy. It's very healthy for people to have these debates, ask what's going on, and really delve into the fundamentals, right? What are the loan to values? What are we seeing in terms of performance? In our loans, and we have a very large non-sponsor-backed and sponsor-backed business with a BDC as well, we are seeing excellent underlying performance. Like we're not seeing challenges in terms of the performance of the businesses. So I don't see huge weakness throughout the markets.
We're not seeing redemptions?
We're not seeing that. No, we're not seeing that. And obviously we don't. We have mostly institutional capital,
right? Sure.
So we have mostly institutional capital. So I do think that this is a moment. I think it's great to have a sort of it's been very, very easy conditions over the last decade, right? And so I do think this is a good moment for people to understand how these vehicles work and to really ask those questions, right? Because it's been too easy for the last decade.
One of the advantages of working with institutions is you can have a one-on-one dialogue. Yeah. Whereas with individuals, their primary source of information is often kind of the headlines that they read. But I only highlight that because I agree with Anne. Institutionally, for us at least, our fourth quarter was our highest inflows into private credit from institutions. So they're acting very, very differently than what you're seeing on the individual side to some degree. Because remember, we're talking about 7% redemptions. 93% are kind of actively, staying involved in the asset class because of this return premium.
Vivek, what sort of sentiment are you seeing on your platform?
Yeah, so look, our platform is a little bit different because, and this is a bit by design, and it's different in two respects. One is that we've historically been an institutionally oriented private credit business, and we want to stay that way. We do have, obviously, evergreen money. Our U.S. evergreen complex is about 17%, of our kind of private credit AUM, and within that, the majority of that actually comes from our own kind of ultra high net worth sort of version of retail, plus institutions. And so we do have some traditional retail, but for us that's a kind of a single digit percentage. We think that's important for two reasons. One is that we think that it's important to have diversified sources of funding, particularly when you get environments like this, because we knew that there are going to be environments where markets cycle, sentiments cycle, and so we didn't want to kind of overly subject ourselves to kind of technical sort of inflows and outflows. I think the point that Anne made is important, which is I think you have to separate out the technicals from the fundamentals. When you look at the fundamentals of both private credit and public credit right now are still strong. Like what we're seeing with publicly traded companies in the economy, earnings are growing, gross margins are improving, free cash flow is being generated, leverage is coming down. I was looking at it last night. I think the default rate right now in private credit is something like 1.3%. default rate in public credit is right around 1.3%. If you add back LMEs, maybe you get to 4-something%. But you're still, you're still at a sort of a relatively healthy point. That doesn't mean there's not risk in the world. That doesn't mean that if there's a recession, those default rates won't go up. We have to be prepared for that. But from our standpoint, in terms of technical flows, we actually, the month we just had was actually the second best month we've ever had in terms of inflows. And we've seen redemptions come up a little bit, but still kind of well below the 5%.
Can I just ask, is there a level, Vivek, where the technical problem becomes a fundamental problem, where there are a wave of redemptions that the industry struggles to meet just because of, again, the illiquid nature of private credit?
Yeah, look, I think that, again, this is where the structure really matters, which is that there is asset liability matching, and there is relatively low leverage. I mean, these vehicles are leveled, give or take, sort of 1-to-1. And so if you think about sort of that downside case, on average, when we kind of look at loans sort of in the portfolio, they have a kind of a weighted average life of sort of 3 to 4 years, before they get kind of refinanced or taken out. Obviously the final maturity on new loans is usually 6 or 7 years. But if you think about that scenario where the redemptions would persist, one, all of these vehicles keep a liquidity sleeve. Different people have different levels of liquidity sleeve, but generally it's 20% or higher. So just that liquidity sleeve, kind of covers a full year of redemptions. And then beyond that, because of the structure of the vehicle, and this is why I said earlier, this is a feature, not a bug. There's really no reason. There's no, people don't have facilities where they have margin triggers. There's really nothing that would kind of accelerate sort of forced selling. So I think if you saw a period of sustained lower inflows and higher redemption rates, all that would happen is, spreads in the industry would go up. We might be starting to see that right now. We're kind of in the middle of a price discovery. And when you zoom out over the last couple of years, spreads have actually been coming down. So if you look at 2022 and 2023 versus now, spreads have come down a bit. To Brad's point, still a premium to broadly syndicated loan market. That premium is still there because spreads in the loan market have come down too. And so, if you step back for a second, even though I'm a credit person, I'm glass half empty when I look at downside cases. I'm a glass half full person in life, and I think if the net result of this is people are seeing headlines and they realize that they're not, they didn't fully understand, or they aren't comfortable with the risks they're taking, and they want to go out, and the people that are remaining behind are the people that want to be there. I think those people are going to benefit from higher spreads, and I think that's actually, that balance of capital, I think, is actually long-term healthy for the industry.
And Dani, just if you frame it, because I like how you summarized it, but the U.S. leveraged loan market is about $4.5 trillion. The non-traded BDCs that we're talking about are around $275 billion. It's an important part of the market, but it is a small part of the market. So maybe where I disagree a little bit with Vivek is that there is so much institutional capital available in this asset class that, and we talked about it on our earnings call the other week, we have, I think, $40 billion of dry powder to invest into the private credit markets this year away from our BDCs. So there's just a lot of capital there to invest into this market. And I do agree having these different funding channels is important because it creates stability in the market. But the non-traded BDCs get a lot of attention because they're so transparent. They have these quarterly filings. They have all their assets are listed out, and so it helps having these conversations just to dimension kind of what the market really looks like.
I do think, especially after Blue Owl, which you mentioned, Anne, some of the concerns have been headlines of putting the gates up. Brad, is there a level at which you'd have to put the gates up, or to Vivek's point, is the structure enough where that's kind of a long-fetched scenario, a far-fetched scenario to have to put gates up?
Well, one of the advantages of these credit vehicles is we make term loans. They have a term to them, and most of our products are in their 4th, 5th year of existence. So you have this laddered maturity. And so the funds themselves are naturally creating liquidity. They're turning over. They turn over more actively in a busy M&A market. Our estimation is in a normal year, our portfolio should turn over about 20%. So if you think about that in BCRED terms, that's $16 billion of just turnover liquidity that is generated. So the vehicles themselves are very different than other alternative asset classes because of this structure. And that helps us kind of meet liquidity needs, that helps meet redemption should they be elevated.
So it's a pretty, what is the scenario where you have to gate it then, given all of that?
I think in a scenario where you prorate or you deliver clients what you told them they would be limited to, is an environment where you continue to see really elevated redemptions. Again, separate, and Mark, I'm going to steal your line. The trend lines and the headlines are very different. So if people continue to focus on the headlines, I think that's where you could see elevated redemptions, and you'll have to look at your liquidity period. But again, we never sell these products as 100% liquid products. We're investing in private assets to deliver a premium return for investors. Investors should never buy them if they expect 100% liquidity, and it is a feature, not a bug.
And I was just going to add, the Blue Owl situation, which, got a lot of the headlines and got a lot of the redemptions moving, was actually a structural situation, right? Which was an old BDC structure, which was designed to merge in with a listed BDC. And so there was a whole series of events leading up to the current headlines. And, they were actually able to sell the underlying loans at par, effectively 99.7, to other institutional investors, thereby, I guess, showing that those loans were not in any way undervalued, right? So again, it just proved that it was a structural problem versus an underlying fundamental problem. And so that, I really look at this, and again, I go back to having invested for 25 years in these products. I think money I'm putting into these is money that I'm sort of putting aside. Do
you think the industry as a whole, though, has done a good enough job explaining that, or does the most recent ruckus show us that maybe not, that we have some work to do?
1,000% that you're correct. That it's more education. You can invest in something and think you understand how it works, but until you've actually lived through it, you don't know, right? And I think that's what this is proving to me. It's a structural element, and people now understand there are limits to getting out. But again, like credit is, as we just said, is much more liquid than many other asset classes, like real estate, like infrastructure, like PE. So there's inherent liquidity, right? Which, if you just sit back, it's going to pay off, right? Like, so I think this is a teaching moment. I think it is a real teaching moment for the industry, and again, that the headlines are going to cause people to ask the questions and are going to cause people to look under the hood. I actually think it's a good thing to have those questions asked.
I say one of the criticisms I often hear, and Vivek, I'd love to get your opinion on this, just because you described the very deliberate nature at which you moved into a more wealth and retail audience, is that the incentives get flipped around. If you're bringing in a lot of money, and because of the structure, they have to get put to work. So deal teams get overruled by IC, and deal quality goes down. Do you think that's happening, that deal quality is going down because these assets need to be put to work?
Look, I think that is a risk, right? So when I said earlier, I think that there's a role for retail money, but it needs to be done the right way. The other part of kind of doing it the right way is to make sure that it doesn't actually change the incentives that the GP has from being an investor to being a deployer. And again, one of the reasons that more than the vast majority of our capital is institutional drawdown is we like that flexibility to modulate because it allows us to be really patient and kind of really credit selective. I think that that's really important. The other thing I'd say, and I know we're not alone in this, we invest all of our vehicles kind of through the same process. So whether it's an institutional drawdown fund or a sort of an evergreen type vehicle, it's the same rigorous diligence process. It's the same investment committee. And everyone kind of shares in what comes out of that investment committee kind of formulaically. There's no kind of picking and choosing this type of deal for that type of vehicle, et cetera. It's a single standard, and I think that if everyone in the industry did that, I think that would be a good thing.
Brad, just 30 seconds to take us out. Is your selection process very similar to that as well?
100%. Our individual products, our insurance products, and our institutional products all share in the same deals. And they're allocated based on available capital. And the only thing I would add to what Vivek said is I think the growth in private credit is actually having a little bit of the opposite effect, which is it's allowed participants like us, like Goldman, to invest in larger and larger companies. And I would suggest that investing in larger companies actually are better risk profiles. And so we're actually creating better portfolios because of the scale in the industry.
Okay, well, we could truly do this all day.
Yeah, we could.
We're going to have to leave it there. Thank you all so much for joining me. Everyone, please join me in thanking our excellent panel of Anne, Vivek, and Brad.